You know, when most people think of Ralph Lauren, they have a very specific image in their head. Maybe it's the iconic polo player on the chest. Maybe it's the smell of a specific cologne. Or maybe it's just the idea of classic American prep. But if you look at the stock chart right now, the image is something completely different. It looks like a rocket ship.
It really does. It's been on an incredible run. And honestly, it brings up one of the toughest questions in investing. When you see a company that is fundamentally crushing it, just firing on all cylinders, but the stock price is sitting right near its all-time high, do you chase it or do you sit on your hands and wait for a dip that might never come?
That is the million-dollar question today. We are diving deep into Ralph Lauren Corporation, ticker symbol RL. And I have to say, the data we have in front of us is fascinating because it's a bit of a tug of war. We have some metrics screaming buy and others screaming wait.
Exactly. It's a classic battle between value and momentum. On one hand, you have a business that is operating at an elite level. On the other hand, you have a valuation that leaves absolutely zero room for error. So, today we're going to break down the next great chapter strategy, analyze these insane margin numbers, and finally decide if there is actually a trade to be made here.
Let's start with the good stuff. Because when we say they are operating at an elite level, we aren't just throwing compliments around. The numbers are genuinely startling for an apparel company.
They are. The headline number here is the gross profit margin. It's sitting at 69.22%.
69%. Just for context for our listeners, that is not normal for a company that sells clothes.
Not at all. That is elite. That is approaching true luxury territory. And what that tells us is that Ralph Lauren has pricing power. They aren't having to slash prices or fill up the clearance racks to move merchandise. They are selling premium goods at premium prices, and people are paying it.
And that connects directly to this strategic shift they've been talking about, right? Moving away from the department stores.
Precisely. This is the direct-to-consumer or DTC shift. In the past, RL relied heavily on wholesalers. Think of your big department stores. The problem with that is you lose control. If the department store panics and runs a 40% off sale, your brand looks cheap. By shifting to their own stores and their own e-commerce, RL controls the price, they control the inventory, and they keep that massive margin for themselves.
So they are essentially gentrifying their own brand. They are kicking themselves out of the discount bin and moving behind the velvet rope.
And that's a great way to put it, and it's working. If you look at their efficiency, the return on equity, or ROE, is 33.42%. That is a very high number. It means management is incredibly efficient at taking shareholder capital and turning it into actual profit.
Okay, so we have established that the business is healthy, the margins are fat, the strategy is working, and the brand is strong. So why isn't this a slam dunk buy right this second? Why did our initial analysis give this a hold rating with only 65% confidence?
Because the market isn't stupid, the market sees exactly what we see, and because of that, the stock price has been bid up to reflect near-perfect execution. We are looking at a price-to-earnings ratio, or PE, of about 26.57x.
26 times earnings. That is steep.
It is steep for a consumer discretionary stock, meaning things people buy when they have extra cash. A PE of 26 is usually reserved for high-growth tech companies or ultra-luxury houses like Hermes. It suggests that investors are expecting huge growth, but here's the catch. The revenue growth is forecasted at only about 6.75%.
Wait, let me get this straight. You're paying a tech stock multiple for single-digit sales growth?
That's the conflict. Now, to be fair, the earnings per share, the profit, is expected to grow near 20%. So they are squeezing more profit out of every dollar of sales. But still, when you pay 26 times earnings, you are betting that nothing goes wrong. If the economy sneezes, if consumers suddenly tighten their belts, that multiple could collapse.
So the bear case here isn't that Ralph Lauren is a bad company. It's just that it's an expensive stock.
Exactly. The bears would argue that the easy money has already been made. The stock is trading near its 52-week high. If you buy now, you are buying at the top of the chart, hoping it goes higher. That's psychologically hard to do,
It feels like buying a ticket to a concert after the main act has already started playing. You're worried you missed the best part.
right? But, and this is a big but, there is another side to this story. We just talked about the fundamental valuation. But if we look at the technical analysis, specifically for traders, the story changes completely.
Okay, let's pivot to the charts. Because I know we have some data here suggesting a strong buy signal if you look at the right time frame. What are the charts telling us?
The charts are telling us that the bulls are in control. The stock is in a clear long-term uptrend. It is trading well above its 50-day and 200-day moving averages. In the world of technical analysis, that is what we call stacking. It confirms momentum.
So the trend is your friend here.
It is. The stock recently pulled back to around 355 and bounced right off it. It's now consolidating, kind of coiling up like a spring right below the $365 level.
And consolidation is often a precursor to a breakout, isn't it? It's like the stock is catching its breath before the next sprint.
Exactly, and we have institutional support here too. We saw data that big firms and smart money are increasing their stakes. One firm, Bernie Company, boosted their holdings by almost 200%. They aren't scared of the valuation. They are betting on the momentum.
That is a huge vote of confidence. So we have a situation where the value investor says wait, but the momentum trader says go. How do we reconcile that?
You reconcile it by defining your timeline. If you are looking to hold this stock for 10 years and you want a bargain, you probably wait. The discounted cash flow models suggest the fair value is closer to $305. So fundamentally, it's overpriced.
But
But if you are a swing trader or looking at a 6 to 12-month horizon, the setup is actually fantastic. You have a catalyst coming up with earnings in February, you have analyst price targets being raised to over $400, and you have a clear technical pattern.
let's talk about that pattern. We mentioned a swing trade. For our listeners who might not be day traders, what does that actually look like for RL?
A swing trade here is about catching the next leg up. We aren't trying to marry the stock, we're trying to date it while it's hot. The analysis points to a very specific trigger. We are looking for a breakout above $365
Why 365? Why is that the magic number?
because that's the resistance level. That's the ceiling the stock has been hitting its head against. If it breaks through $365 with volume, it proves that the buyers have overwhelmed the sellers. It clears the path back to the 52-week high of $380.
Okay, so if it breaks 360 files, the door opens to $380. And if it clears $380,
Then you are in blue sky territory. There is no historical resistance above an all-time high. The next target based on analyst projections would be around $409.
that's a significant upside. We're talking about a potential 12% run from here. But we have to talk about the risk. What if we are wrong? What if the consumer stops buying cashmere sweaters next week?
That is the biggest risk. This is a cyclical stock. If we hit a recession, luxury spending is the first thing to go. And remember, this stock is priced for perfection. If they miss earnings or if their guidance is soft, the fall could be painful.
So how do we protect ourselves?
We use strict stops. The analysis suggests that if the stock falls back below 353, the bullish thesis is broken. That's your get out signal. It means the support didn't hold and the trend might be reversing.
So the risk-reward profile is actually pretty defined. You're risking a drop from $365 to $353, about $12, to potentially gain a run to $409, which is over $40.
Exactly, that's a 3-to-1 risk-reward ratio. In the trading world, those are odds you take every single day.
It's interesting, isn't it? We started this conversation worried about the high PE ratio, but when you look at the structure of the trade, the high price actually comes with a lot of momentum backing it up.
It does, and you can't ignore the quality. I want to circle back to that ROE of 33%. Companies that efficient tend to outperform over time because they have extra cash to do things like buy back shares. And RL has been doing that. Share buybacks act like a floor under the stock price,
That's a great point. Even if revenue growth is slow, if they buy back enough shares, the earnings per share keeps going up, which helps justify that high stock price.
right? It's financial engineering, but it works. Plus, let's look at the bear argument again. They are worried about valuation contraction. But what if the market decides that RL deserves to be treated like a true luxury stock?
You mean like LVMH or Hermes?
Maybe not quite that high, but higher than a standard retailer like Gap or Macy's. If the market re-rates RL as a quality compounder rather than a cyclical retailer, that PE of 26 could actually sustain itself. It might not be expensive, it might just be the new normal for a company with 69% gross margins.
That is the bull case in a nutshell. Quality justifies the price.
And honestly, the sentiment data backs that up. We have 28 buy ratings from analysts and only 14 holds. The consensus is shifting. The institutions are voting with their wallets. The chart is pointing up.
So let's try to bring this all together. We have a company that has successfully reinvented itself. It's profitable, it's efficient, and it's growing earnings. But it's expensive. It's sitting at the high rollers table now.
It is, and that means you have to be disciplined. This isn't a stock you just blindly buy and forget about right now. You have to watch the levels.
It feels like we are at a decision point. The stock is hovering, waiting for a catalyst. Maybe it's the earnings in February, maybe it's just general market strength. But the coil is tight.
The coil is very tight. And usually when a stock with this much institutional backing coils up near an all-time high, the resolution is upward.
But we have to keep our eyes on the macro picture too, right? You mentioned the recession risk.
Always. If the S&P 500 rolls over, RL will likely go with it. It's a high beta name. It moves more than the market. But as long as the general market holds up, RL looks like a leader.
It's refreshing to see a legacy brand actually pull off a turnaround. We see so many retailers try to elevate and fail. They just end up confusing their customers. But Ralph Lauren seems to have pulled it off.
They stayed true to their core identity, but fixed the business model. They stopped giving their profit away to middlemen. It sounds simple, but it's incredibly hard to execute. And the fact that they did it is why they have that 33% return on equity.
And that execution is why the smart money is piling in. Okay, I think we have a pretty clear picture here. It's a quality house in a nice neighborhood, but the asking price is high. The question is, are you willing to pay up for the view?
If the view includes a breakout to $400, I think a lot of people are willing to pay.
All right, let's wrap this up and give our listeners the concrete steps they need. We've talked about the what and the why. Now let's give them the how.
Let's do it.
Based on everything we've analyzed today, the fundamentals, the technicals, and the swing trade setup, here is your call to action for Ralph Lauren Corporation.
If you are looking to enter this trade, patience is your best friend right now. Do not buy at the current market price of $363 just yet. You are waiting for the trigger. Start investing only when you see a confirmed breakout above $365. We need to see the price cross that line to confirm the momentum is real.
And once you are in, you need to know when to fold if it goes wrong.
Exactly. To mitigate your risk, you need to set a hard stop. Leave the market if the price closes below $353. If it hits that point, the setup has failed, and you want to protect your capital.
And on the upside, where are we taking profits?
We have two targets. The first place to consider taking some profit is at the previous high of $380. If it blasts through that, you hold the rest for the secondary target of $409. That is where the risk-reward ratio is maximized.
Break out at $365, stop out at $353, targets at $380 and $409. Clear, concise, and actionable.
That's the plan. Trade the levels, not the emotions.
Thanks for tuning in to another deep dive. We'll see you on the next one.
Disclaimer statement. The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.